In 2008, the global financial system came dangerously close to total collapse. Within months, trillion-dollar banks failed, stock markets crashed, and millions of people lost their homes, jobs, and savings. It was the worst economic crisis since the Great Depression, fueled by unchecked greed, excessive leverage, and the illusion that financial innovation had eliminated risk. To understand how the world reached that point, we must rewind to the early 2000s, a period defined by cheap credit, soaring home prices, and blind faith in endless growth. Following the dot-com crash, the U.S. Federal Reserve slashed interest rates to historic lows. Borrowing became easy, and homeownership exploded. Banks and mortgage lenders, chasing profits, began issuing loans to virtually anyone, including those with poor credit histories. These high-risk, subprime mortgages were the seeds of disaster. Wall Street saw an opportunity. Financial institutions bundled thousands of these mortgages into complex securities known as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These products promised high returns with supposedly minimal risk. Credit rating agencies, motivated by the fees they received from the same firms they rated, stamped many of these securities with AAA ratings, the mark of safety. Investors around the world poured money into them, unaware that their value depended on homeowners who could barely afford their loans. As long as housing prices rose, the system appeared flawless. Everyone, from lenders to investors, made money. But this prosperity was an illusion built on leverage. Banks borrowed enormous sums to amplify profits, sometimes at ratios of 30-1, meaning a mere 3% loss could wipe them out. When interest rates rose and home prices stopped climbing, the structure began to crumble. By 2007, cracks in the system had become impossible to ignore. Homeowners began defaulting in record numbers, causing MBS and CDO values to plummet. Financial institutions holding these assets faced devastating losses. Yet few realized how interconnected global finance had become, or how quickly fear would spread. The breaking point came in September 2008, when Lehman Brothers, one of Wall Street's oldest and most prestigious investment banks, declared bankruptcy. The event sent shockwaves across the world. Lehman's collapse shattered confidence in the entire banking system. No one knew which institutions were solvent and which were not. Credit markets froze. Banks refused to lend to each other, fearing hidden exposure to toxic debt. Within days, panic engulfed the financial world. AIG, one of the largest insurance companies, teetered on the edge of collapse due to its massive bets on mortgage securities. Washington Mutual, the largest savings and loan association in the U.S., failed in the biggest bank failure in American history. Major players, like Merrill Lynch, were forced into emergency mergers just to survive. The Dow Jones Industrial Average suffered its largest one-day point drop in history. For ordinary people, the financial chaos translated into real pain. Millions of Americans lost their homes to foreclosure. Unemployment soared. Retirement accounts and life savings evaporated. The ripple effect extended far beyond the U.S. European banks that had invested in U.S. mortgage securities faced collapse, and global trade slowed dramatically. At the heart of the crisis was a dangerous dependency on leverage and confidence. Modern banks had borrowed heavily to fund risky long-term investments. When confidence vanished, they ran out of liquidity almost overnight. The financial system, built on trust, found itself paralyzed by fear. Governments had no choice but to intervene. In the U.S., Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke spearheaded the largest financial rescue in history. Congress passed the $700 billion Troubled Asset Relief Program, TARP, to inject capital directly into failing banks. The Federal Reserve cut interest rates to near zero and launched quantitative easing, printing money to stabilize credit markets. Similar rescue efforts took place across Europe and Asia. Central banks guaranteed deposits, nationalized major lenders, and coordinated emergency lending programs. These drastic measures prevented a total collapse, but the global economy still plunged into recession. By 2009, U.S. unemployment had soared above 10%, and global GDP contracted for the first time in decades. The aftermath left deep scars, both economic and political. Many of the financial institutions responsible for the crisis were bailed out, while millions of ordinary citizens bore the burden of job losses and austerity. Public outrage grew as executives received bonuses funded by taxpayer money. The crisis exposed the fragility of modern capitalism and eroded faith in government and financial institutions alike. In response, regulators introduced sweeping reforms. The U.S. passed the Dodd-Frank Act in 2010, creating new oversight agencies, requiring stress tests for large banks, and limiting excessive risk-taking. Globally, the Basel III framework raised capital requirements and introduced stricter liquidity standards. These measures aimed to make banks more resilient, though critics argued they didn't address the deeper moral failures that led to the crash. The long-term consequences were profound. The crisis ushered in an era of ultra-low interest rates and unprecedented central bank intervention. While these policies stabilized markets, they also fueled inequality by inflating asset prices and enriching investors. Many middle-class families, meanwhile, struggled to recover. The resulting frustration and disillusionment gave rise to political movements like Occupy Wall Street, Brexit, and populist waves across Europe and the United States. Perhaps the most important lesson from 2008 is the fragility of confidence. The crisis revealed that modern finance, no matter how complex, still depends on trust. Once that trust breaks, even trillion-dollar systems can unravel in days. It exposed the dangers of a financial culture driven by short-term profit, moral hazard, and the belief that markets can regulate themselves. 17 years later, the world continues to feel the echoes of 2008. Every market crash, every debate over regulation, and every warning about excessive debt carries its shadow. The crisis taught us that innovation without accountability leads to disaster, and that greed, when left unchecked, can bring entire economies to their knees. In the end, the 2008 financial crisis was more than an economic event. It was a moral reckoning. It forced the world to confront the cost of ambition without responsibility and reminded us that stability, once lost, is painfully slow to rebuild.